every single day, the world seems to be getting more uncertain and confusing. Huge losses in stock market, people unsure about the economy. Where do we go from here? Well, the person to help make sense of all that for us is one of the most successful living natural resource, commodities, precious metals investors in the world today, and a regular on our channel, and one of my mentors. He has managed well over billions of dollars with Sprott in the past, and is now what he would call semi-retired but very active, and that's Rick Rule. So we want to welcome Rick today. Thank our sponsor, Vizsla Silver, one of our favorite silver and gold mining stocks. So thank you, Vizsla Silver. And I want to thank you for watching today. If you enjoy this episode, make sure you smash the like button, subscribe, bell notification. And Rick, good to see you.
Jake, always a pleasure. Thank you for having me back.
When you look at the world today, there seems to be every wave where people think maybe we're kind of out of the clear. There's kind of another wave, and nobody seems to really be able to make sense of what's happening. The stock market, the interest rates, inflation, what's going on, and how does someone make sense of it?
Well, the first thing I think is to understand that you will never make sense of all of it. The idea is, and this is meant to be a laughable quote, to keep your head while all those about you are losing theirs. You can't control the way the world works, but you can control the way that you react to it. It's important too, Jake, even though the world faces a lot of threats, to maintain a sense of optimism. A sense of pessimism, when you are surrounded by the volatility that we're surrounded with, causes you to coil up and do nothing. And doing nothing is precisely the wrong result. So understand, first of all, that you aren't going to understand it perfectly. Understand that just because it ends poorly for many doesn't mean it needs to end poorly for you. Our mutual friend, Doug Casey, called his first newsletter Crisis Investing, after the Chinese parable that the Chinese sign for crisis and the Chinese sign for opportunity were in fact the same. What one must do is maintain agility, maintain confidence, maintain even aggression in a circumstance where doing nothing simply is not an option. We have lots of, how would you say, colliding forces. The deleveraging of the Fed balance sheet, quantitative tightening, taking money out of circulation. At the same time that we have negative real interest rates. So a very deflationary action in very inflationary times. Add on top of that, incredible public sector debt with popular demands for more government spending. In other words, the voters seem to be asking us, despite the fact that we're deep in a hole, to dig more. So there's all kinds of things out there, and I think the best that one can do is prepare one's own self to deal with the circumstances that come to them. One example, Jake, and I'm sorry for this long-winded answer. One example is to look at a pattern of falling prices around assets that one wants to own as a good thing, not a bad thing. We've talked before about the fact that declining prices, in fact, a bear market, is financial speak for a sale. And sales are good things. Many of us don't like the fact that some of the goods that we already have in our inventory are declining in price. It isn't merely the price of opportunity that's falling, it's the price of inventory that's falling too. But I suspect, Jake, that if your listeners develop a sense for why they made their investments, which is to say, if they begin to make their investments based on value rather than narrative or momentum, that they will have the confidence to not just stay the course, but increase their exposure to sectors that make sense. And they will come out of this circumstance, and we will come out of it. They will come out of it individually in much better shape than they went into it.
What is your best speculation on when and how we come out of it? Do they raise rates until there's a credit crisis? Do they wait until everyone's yelling too much because now their asset value have went down and it hasn't even stopped inflation? What's your best speculation?
My best speculation, and please understand, I'm not an economist. My best speculation is that we are going to have a liquidity crisis, that we're going to have a crisis in confidence. I believe, I hope I'm wrong, that the system has both too much confidence and too much debt in it. If interest rates were to be normalized, Jake, they would have to go to a positive real yield. Given that the underlying rate of inflation is 9%, a positive real yield would imply a 10% 10-year treasury, which would imply federal, state, and local governments paying a third of their current income by way of interest without having very much money left over for the services that citizens demand. Traditionally, the 30-year mortgage rate is traded in front of the 10-year treasury, which would suggest a first-year mortgage rate, a 30-year fixed mortgage rate with some number like 10.5 or 11. If you think real estate prices have fallen a little bit in the last little while, think about what an 11% 30-year fixed rate would do. Now, I'm not one of these who believes that we're at the end of the world, that there's going to be widespread breadlines. I am of the belief that it is more likely than not certain, but rather more likely than not, that certain categories, and I don't know what they are necessarily in the credit market. I suspect personally that they're going to be corporate junk debt, but that doesn't matter, are going to be faced with the specter of much larger than anticipated defaults. And when the default cycle begins, a few things happen. The investment banks and the commercial banks, when they understand the damage that's been done to their portfolio, assume that the same damage has been done to counterparty's portfolio, and money seizes up. Liquidity goes away. And when liquidity goes away, confidence goes away. Will it be a replay of 2008? I don't know. But my suspicion is that one needs to orient their portfolios and orient their minds in anticipation of the probability that we face a liquidity and confidence squeeze. Let's say that you're careful for 2 years and nothing happens. What have you really lost? Not much, except for 1.5 or 2 years worth of opportunity. Let's say, by contrast, that you continue to speculate in crypto products that you don't understand, in technology stocks, in penny mining stocks, in over-leveraged real estate. Let's say that you play the game really, really, really aggressively, and we have a replay of 2008, and you lose 90%. My suspicion is that at least the middle course, which is to say that people only invest in things they understand and maintain more liquidity than they otherwise would in the face of 9% interest rates, is the correct course of action.
You and I have talked, we'll just say our last few months of conversations as we've kind of been in this type of environment. You've been saying it is your personal speculation or opinion that there's a lower leg to come. And you said at the same time, a lot of mining stocks that I like, whether it's in uranium or gold or what have you, are at good prices. How do you go about navigating what's worth buying at discounted prices and how much you exercise self-control in preparation for what you just stated, where if there's a credit defaults, obviously you're going to have at least a brief period of time where one would suspect everything would be on an even greater sale. How do you navigate those two in an environment like this?
The answer, sadly, is different for every individual speculator. Take an old fat guy like me. I've been lucky in life. I've worked hard. I've saved. And I'm old. I'm 69. My money probably, with any luck, has to last me 40 years, but not a lifetime. I can afford to be more aggressive. But despite the fact that I can afford to be more aggressive, I'm very, very, very liquid. I'm actually more liquid than I would like to be. I'd like to be more exposed to risk. But understand that my exposing myself to more risks comes in the context of being old and fat and rich. And it also comes in the context of being very experienced in times of turmoil. I survived barely the collapse of the commodities boom in the late 70s. I survived the October 19th, 87 crash in much better condition. I survived the tech wreck. I survived 2008. I survived 2010. I'm psychologically and financially able not just to ride through this circumstance, but actually take advantage of it. You too, at your young age, as a consequence of the success of your own business, have the financial resources that if you exercise discipline with regards to how much money you allocate to speculation and continue to invest in your own business, bringing utility to the customers, you'll get through this well, almost no matter what. The people I'm concerned about, Jake, are the people whose skill level and customer base is marginal. Those subscribers that you have that are in highly contestable jobs, where they might lose their job in an economic slowdown. Those people who are struggling to pay their consumer debt and their mortgage simultaneously, that may, as a consequence of losing their investment cushion or losing their job, lose their house. It isn't you or I that I'm concerned about. We will come through this with some new scars, but likely we will come through it absolutely better off, and compared to our competitors, decidedly better off. But many of your subscribers, Jake, are not in the circumstance that we are. Those subscribers need to build large cash cushions, particularly those subscribers who are in contestable jobs that could be exported, jobs with companies that are marginally profitable. Those people need really to be concerned about their ability to maintain their living standards, and that's going to require cash.
So let's talk about cash in a minute, but before I go there, just a quick question to wrap up on your last point. You said you're in more cash than maybe you'd like to be. I know that you've said before that we'll use, just for example, commodities and uranium and metals, mining stocks in general. You've said a lot of them are at very reasonable prices. Is the reason that you're in such high cash not have to do with the price and value of those stocks? And is it more predicated on what you stated earlier, your belief that we're headed lower before higher in this type of credit muckiness that we're in?
It isn't strategic at all, Jake. It's tactical. I had some real estate assets that I'd held for a very long time. And I continued to hold them during a period of declining interest rates, because I saw, as interest rates declined, that the capitalization rate around those assets increased. When I saw a circumstance about 2 years ago where I didn't believe interest rates could go any lower, I thought that as a non-professional real estate investor, that I had taken the best part of the cycle, and I decided to sell that portfolio. Similarly, I relocated from the state of California to the state of Washington. So I had a couple of other assets that were California domiciled. And I believed and continue to believe that, at least for the near term, the golden age of California is past. And so I sold those assets. The consequence of those sales, nothing else, has caused me to be way, way overweight cash.
Roger, so let's talk about cash. The very first time you and I met, I'm not sure if you recall, it was at your office when you were still in Carlsbad, and I was kind of telling you my goals, my businesses, and just like you were giving me really a nice mentor session. And my biggest takeaway then, which was probably at the end of 2019, was you said focus. You basically told me not to even worry so much about mining stocks and focus on my business and building cash. Why did you give me that advice? And does that tie into this picture of you said a lot of people, there is a high percentage of people listening that need to focus on their cash and their income streams as their primary means of focus?
You know, Jake, one of the things I've liked to do for years is talk to clients and associates who own their own business. And uniformly, when I do that, they're scared to death of the broad economy. And they're very confident with regards to their own business, which means that successful business people know how to navigate multiple economic conditions. What that means is that most people add value in their business better than they add value in their investments. And they also have a psychological profile to endure risk and be nimble in their business where they don't in their portfolio. So for everyone whom I have ever met that is a successful entrepreneur, the best place for them to focus their efforts and their capital is on their business. When you get to the point where I got, a little older than you are now, where your business is generating more surplus cash than you can feasibly redeploy in it, then you begin to invest. And when you have invested enough that you have, in an off-color sense, your FU money, you begin to speculate. I would suggest that an investor is a person who deploys capital on the probability of earning a reasonable return on capital employed. A speculator is somebody who can afford to take real risks in return for outsized returns. And I think that the asset allocation matrix goes very much like that. In the beginning of your career, stay liquid so that you can take some risks with your business. Put your effort and your cash into your business until your business is generating surplus returns. When the business is generating surplus returns, depending on your psychological tolerance for risk, invest and or speculate with the surplus capital.
You know, you're known in this kind of niche as obviously one of the more successful and famous type of commodities and mining stock investors. And you got your good story about Paladin going from whatever 1 cent or 10 cent to $10 and that type of stuff. But you know, you've built a lot of your capital and your brand actually not as an investor, but as a business owner, serving customers and clients and, you know, doing a good job of that. And so that's kind of interesting that you don't really realize on surface level. But if we dive deeper into that, how can someone get going in that way? How can I earn more money? What do I do if I listen to this and I go, oh crap, I realize my biggest problem is security of cash flow and growing my cash flow, or I need a business and I don't have one. Where do I start? What do I do?
Well, I need to disclaim something, Jake, and I hope your viewers don't take this too seriously. Almost everything I just told you to do, I didn't do. I started off speculating aggressively. And the consequence of that is that after being a very wealthy young man, I ended up having a negative net worth. A hard lesson. I have made much more money investing than I have building businesses. But the truth is, I've made a lot of money at both.
Yeah. Okay.
For most people, what I hope they can do is avoid some of the scars that I gathered early in my career by taking risks that were inappropriate for at least who and where I was financially. For many people, Jake, starting a business, operating their own business, isn't the highest and best use of their talent. For whatever reason. And you can certainly make yourself materially wealthy and a happy person working in someone else's business. What is important to understand is what task that generates value for other people do you enjoy doing so much that you're thinking about it when you wake up in the morning and you're thinking about it when you go to bed at night. If you are competing with a wage slave, if you are competing with somebody who works 8 hours a day, punches the clock and goes home and tries to drink themselves into a stupor so they forget about the day they just had, and you love the task so much that even when you aren't at work, you're thinking about it, you're going to outcompete that person. You're going to outcompete him in the first year, but the second year you're going to outcompete him compounded. And by the fifth year, if you're thinking about what you're doing 15 hours a day and your competitor is drudgingly doing it 8 hours a day, you're going to be so far ahead of them that it's going to take them a telescope to see you. So identify a task where you deliver value for others and you're interested in and enjoy the process. The second step, and this came to me at age 30, this is going to sound really strange. Don't worry about making money. Worry about generating utility for your customer. If you worry about generating utility for your customer, the money will come in and of itself. So as an example, if you're designing a self-help product, don't worry overly about any aspect other than servicing the customer's need with a course that is the very best you can do and substantially better than the course offered up by your nearest competitor. When you do that, as you did, the thing that appealed to me when you came into my office in Carlsbad as that young, gentle hippie 5 years ago was the passion with which you described your self-help business, how good it felt to help people turn their lives around. You didn't tell me how much money you made. You didn't tell me what kind of car you drove. You didn't tell me about your desire for a home in Rancho Santa Fe. What you told me about was how you were involved in the process of learning how to teach other people to make their lives better. It was precisely that passion that told me, if this young guy can take that passion for self-help and teach his generation more about finance, he's got a hell of a career ahead of him, and I owe it to myself to help him.
I like what you said there because I feel like, especially if you're stuck, it's easy to overcomplicate it because you hear all these terms. You got to be a business owner in this. So then you might overthink like, okay, well, what business do I do and how do I start the business? But you simplified it in a way that's like, don't even worry about it. You could be an entrepreneur or an entrepreneur working in someone else's business. At the end, you could be a wage slave right now, but you're saying put all of your energy into a task that you can perform valuably and improve upon, basically. And if you do that effectively, then you're golden.
Absolutely. I mean, Jake, there's going to be a copywriter out there who can convince people to buy his or her courses or courses that they package from other people. And that person might outcompete you in 2022 or 2023. But if all of their effort goes into copy and nothing in the course, you're going to kill them in 5 years. I don't mean you're going to beat them, Jake. I don't mean you're going to beat them. I mean, you're going to slaughter them. They're going to self-destruct. And you are going to have a reputation for self-improvement products that causes your customer to be a repeat customer.
So let's end it like this. What are the best questions for me to ask myself so that I could find that thing or focus on that thing? If I watch this interview and I thought, Rick's going to tell me about silver stocks, but now I'm like, oh crap, my real problem is this instead. What questions do I ask myself? Where do I start from?
Where does the market have a product hole that I can fill profitably? Entrepreneurs identify market imperfections. They look at the market and see products or services that there is demand for from a constituency, hopefully, that they know how to address or already have. And they design in their own mind the best possible product to fill the need. By the way, this works in investing too. If you look across the investment landscape, I've told you often, Jake, you find a commodity that is needed for the material success of humankind, where the industry is pricing the product at less than the cost of production. That means that either the price of the commodity goes up or the commodity becomes unavailable. In the course of something like electricity, the commodity being uranium, it's almost inconceivable that the price stays down long enough that the lights don't go on. So the process of being a speculator and an investor is not unlike the process of being an individual entrepreneur. You see a need in the market, you see a market imperfection, and you attempt to fill it in as intelligent a fashion as you can. I think the process in both cases is the same. As an investor, you're looking to make decisions that are fact-based, not narrative-based. When commodity prices are high, ironically, the narrative that talks about that commodity is most in vogue because the narrative has been demonstrated by the price. So the narrative becomes the truest to most people when the prices are high enough to invalidate the narrative. The same thing happens, I think, in your own life. There's a stasis that causes you to say it for a while that all the needs have been filled, which are ridiculous. There are 8 billion people on Earth, and there are an infinite number of communities, or in the science fiction sense, philes, P-H-Y-L-E-S. There are an infinite number of markets that you can serve, depending on the psychological and intellectual profile that you have, depending on what it is that you prepare to offer the market. The process is actually the same. It's just that you need to do the decision-making as much as you can on a factual basis.
So since you brought up commodities, if you wouldn't mind giving us an ending of a bird's eye view, is uranium still the one that you're highest on short term? What's your view on metals and uranium as we see?
Short term, absolutely uranium. You'll recall from prior interviews, Jake, that I said that the catalyst would be the pace of Japanese restarts. Right. The most recent public opinion poll in Japan shows that pro-nuclear sentiment has increased from 21% of the voters to 61% of the voters.
Wow.
That's astonishing. That has given the prime minister of Japan the political leeway to begin the process of restarting 17 more reactors. That isn't to say that new build reactors around the world aren't important or that SMR technology isn't important. But all of that stuff impacts demand 10 years from now. Japanese restarts impacts demand in 2022 and 2023. The second thing is that uranium's still cheap. The total cost of production worldwide, including cost of capital, social rents, and prior year write-downs, approaches or exceeds $60 a pound. And the incentive price for new production is probably $75 a pound. Yet the stuff trades at 50 or 52. With a 75 million pound a year annual deficit, which is growing, deficit meaning the amount produced relative to the amount consumed, we need to get to a price where we incent new production, which means that the price of uranium has to go from $50 a pound to, say, $75 a pound. The impact of that move on uranium producers or developers, potential cash flows, is fantastic. The third thing that happens as the spot market dries up is that utilities will be less able to get secure supplies from the spot market, and they're going to have to go into the term market. They're going to have to contract with producers, which means that the producers' cash flows and earnings and debt service capabilities are going to become much more certain. And it's certainty that raises share prices. So in the near term, the commodity that I like the most is uranium.
How about in the long term?
In the long term, well, it depends on how you define the long term. I think the most misunderstood commodities are oil and gas. I think they go lower before they go higher because we reached prices where people began to conserve, which is to say that the price levels caused demand to be constrained, at the same time that the Russians found a way to avoid sanctions by reshipping oil. So I think in the very near term, oil and gas prices fall. But the big thinkers of the world have convinced most consumers and voters that the internal combustion engine is going to be obsolete in 2030. My own belief is that peak oil demand probably occurs in 2045. We need a transition fuel to get us to the point in time where various energy consumption functions, be they transportation, be they electricity, can be done with non-fossil fuel alternatives. Given the fact that there are political constraints on the oil and gas industry reinvesting as heavily as they had in the past, what you're going to see is a continued constraint of reinvestment capital, which means you're going to see continued supply constraints in the face of what will surprise everybody, continually increasing demand. So I think the most misunderstood commodity for the next 20 years is oil and gas. And for income-oriented natural resource investors, the oil and gas and coal businesses are probably the best place to be. I'm delighted, Jake, to see the weakness in gold prices, and more delighted yet to see the weakness in silver prices. You and I have talked before from a speculative point of view about the fact that when gold establishes precious metals price momentum, the ultimate beneficiary is silver. Silver goes further and faster once a precious metals bull market resumes. And I continue to believe that while the inflation rate will likely fall in the United States from 9.5 to some number like 7 as a consequence of higher interest rates, the structurally high inflation will continue and a negative real interest rate will continue, which is to say the conditions precedent will continue for the gold price. I hope I'm wrong. The circumstance that makes the gold price go up is very hard on the rest of your portfolio, but I think I'm right. And if I'm right about the fact that we will resume a precious metals bull market, the speculative outperformer, if past is prologue, will be silver. And the fact that the silver equities get cheaper by the hour is wonderful for me. While silver's newfound friends 2 years ago that bid those stocks up to levels that I couldn't afford, or at least wouldn't afford, now that the newfound friends believe that silver is a 4-letter word, now that they're kicking it out of their portfolio, I look forward to hoovering it up into mine.
Okay, I just thought of a good final question that I've never asked before. You ready for this one?
Let's see.
All right, so you got $100,000. You have to invest it all this week and only in commodities, natural resources, and you got to hold it for, I don't know, two to 3 years. What percentage of that 100K is going to uranium? What's going to precious metals, and what's going to oil and gas, and other industrial or battery metals?
It really depends on who you are, Jake. I know you want a one-size-fits-all answer because you deal with a large constituency, but that's like wanting the tooth fairy. If you're an old, fat, rich guy like me who can stand volatility, who doesn't need money to get himself through the next couple of years, you put every dime of it in the uranium business. If it amuses you to go for a 10-to-1 in 2 years or 3 years, I don't need it, but I like it, I'd probably do that. For most people probably should have 30 to 50% in the oil and gas business, understanding that the probability is that they generate very good returns for 20 years. And by the way, they have some money to spend in the interim. Probably a quarter of it should go into high quality precious metal stocks. I don't mean the penny dreadfuls. And for people who can afford psychologically and financially the risk, uranium stocks and or juniors with the other 25%. I think your biggest reward and your quickest reward likely comes out of the uranium stocks, but there's no guarantees in life. And I've seen too many young speculators who can't afford the trade put 100% of their net worth and 1,000% of their psychological stability in stocks that are too speculative to occupy either that wallet share or that mind share.
Good answer. Good answer. So, for everyone listening, Rick actually will rank your natural resource portfolio for free. Rick, you want to tell us about that? Anything else you want to mention?
I do. I have unbelievably 3 offers in retirement.
All
The
right,
first,
deal.
the first is if you like what I have to say about natural resources and you want to hear what I have to say about your natural resources, go to ruleinvestmentmedia.com and enter your natural resource stocks. I'll rank them personally, 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think my comments might have value. Be patient. I'm about 300 requests behind right now. The second thing is, now that I'm no longer securities licensed, I can tell accredited investors about the private placements that I'm participating in. I didn't used to be able to do that because it was called soliciting, but I have nothing to solicit. It's free. If you're accredited and you care about the speculative private placements that I'm participating in, when you go to Rule Investment Media, in the question and comments section, write placements, and I'll put you on a list to receive information about private placements I'm doing. Finally, Jake, I'm celebrating retirement by backing some guys starting a new bank, my 7th. For those people who are interested in being depositors in this bank, we will pay in the top decile of deposit interest rates nationwide, or a borrower from this bank, particularly if you're borrowing to buy or own precious metals. When you go to the Rule Investment Media site and you want more information about this bank, by the way, it's in organization, it's not chartered yet, it's in organization, write bank. So rankings, placement, bank. The site is ruleinvestmentmedia.com.
So I want to thank everyone for listening today. If you enjoyed today's episode, make sure you smash the like button on this, subscribe, bell notification, give us a comment down below. This is Rick Rule Rules, and we will link Rick's website right there down below.